All right, let's dive right into this investment explainer. Today, we're breaking down the FY 2025 annual report of the Assembly Place, or TAP for short. They are fresh off their highly anticipated January 2026 public listing on the Singapore Exchange's Catalyst board, and honestly, we're going to lift the hood on what has quietly become one of the most fascinating and frankly dominant real estate plays in the entire region. So, here's our roadmap for today. We'll cover market dominance, diversified brands, the asset light model, FY25 financials, and their path to 10K keys. Starting right off with Section 1, Market Dominance, the post-IPO landscape. Now, TAP entered 2026 armed with $10.8 million from a super successful IPO, fully ready to aggressively expand. But to really grasp their trajectory, you have to look at where they stand right at this exact moment. 34%. That is TAP's commanding market share in Singapore's community living space by key count. Just think about that. More than 1 in 3 community living keys in the entire market is managed by this single operator. For a company that started back in 2019 with literally just 6 rooms, that level of scale is absolutely staggering. Moving right along to Section 2, Diversified Brands, the Competitive Moat. So, you might be wondering, how exactly do you capture 34% of a market? Well, you definitely don't just copy-paste a single dorm room format everywhere. TAPE's competitive moat is built on highly targeted diversification. On one end of the spectrum, you have their newly launched social brand, which targets the premium boutique hospitality and service department sector. And then on the other end, Campus provides purpose-built, highly functional accommodations specifically for tertiary students. In total, they operate across 5 different living sectors. It's brilliant, really, because it effectively insulates their revenue from a downturn in any single demographic. By spreading out across 6 distinct brands, which even includes specialized spaces for foreign healthcare professionals and migrant workers, they've successfully scaled up to 3,422 keys across 100 properties. But for us investors, the absolute holy grail metric here is their 94.4% average occupancy rate in FY 2025. Their heavy focus on community events and shared spaces? Yeah, that isn't just marketing fluff. It creates incredibly high switching costs for residents, making their revenue unbelievably predictable and sticky. Which brings us to Section 3, Asset Light Model, the Financial Engine. So here's the million-dollar question. How do you scale to 100 properties without drowning in massive debt to actually buy the buildings? The secret sauce is the Asset Light Model. TAP leverages top-tier digital infrastructure to manage, operate, and lease a massive portfolio of property assets entirely without the balance sheet-crushing capital requirements of owning the real estate outright. Basically, think of them as the iOS operating system, but running on someone else's hardware. And this agile strategy cleanly divides their business into 3 synergistic segments. Community-driven stays is undeniably the core engine here, driving a massive 93.3% of their total revenue. Then you have investments, where they take strategic minority stakes in property owners to perfectly align their financial interests. And finally, other property services acts as a neat bolt-on value add, offering things like renovation and project management for the asset owners they partner up with. Let's look at the numbers in Section 4, FY25 Financials, the scorecard. It's one thing to have a great business model on paper, but their actual FY25 scorecard is phenomenal. From $6.9 million back in FY22, the revenue has just aggressively stair-stepped upwards, surging by 42.4% in FY 2025 alone to hit $27 million. This incredible top-line trajectory was largely driven by an expanding portfolio of master leases. In simple terms, that means TAP leases a whole building long-term, gives it a major upgrade, and then subleases the individual units for a solid premium. But as we all know, revenue is only vanity if it doesn't translate into actual profit. While their reported net profit was a very solid $6.6 million, actually, scratch that. To get the real story, we need to look under the hood. If we strip out the $1.1 million in one-time, non-recurring IPO expenses, we reveal their true operational health, their adjusted core earnings. That figure rose by over 24% year over year to $7.7 million. This proves that as they scale up, they are generating some serious operational leverage. And finally, Section 5, Path to 10K Keys, the Horizon. Management clearly isn't resting on their post-IPO laurels. They've set this incredibly ambitious target to hit 10,000 keys by the end of 2030. But we have a bit of a math problem to solve here. Between their active portfolio and pipeline projects, like that big 163-room hotel at Trust Street, plus new properties in River Valley, Malaysia, they currently sit at around 5,000 keys. So the absolute vital question for us investors is, how on earth do they bridge that massive 5,000 key gap in just 5 years? Well, the annual report lays out a highly targeted three-avenue attack plan. Avenue 1 is doubling down on their core, direct leases, which is absolutely the most capital-efficient way to grow. Avenue 2 is joint ventures. A prime example of this is their recent alliance with TS Group to launch Commune, which is Singapore's first purpose-built intergenerational living concept. TAP brings the brand, the partner brings the building. Simple, right? Finally, Avenue 3 is co-investments, where they're strategically taking minority stakes to lock in landlord loyalty and capture those sweet asset-level returns. The management team is betting heavily that this aggressive scaling is going to be lifted by some massive structural tailwinds. Just look at this projection. Singapore's co-living market alone is expanding toward a $9.7 billion valuation by 2030. When you combine Singapore's enduring role as a global business, education, and healthcare hub with TAPE's current 34% market dominance, they are perfectly positioned to capture a wildly disproportionate slice of that expanding pie. All of this leaves us with a truly fascinating dynamic to consider. TAP has definitively proven that in the modern era, you really don't need to own the bricks to extract immense value from the building. As community-driven living continues to completely reshape the urban landscape, is this agile, asset-light, digitally driven model the absolute smartest way to invest in the future of real estate? It's an incredibly compelling thesis and definitely one to watch unfold. Thanks so much for joining me on this explainer, and keep learning.